Hello, Michael Cochran here with BentOak Capital, providing you with a brief update for February 2025. Please stay tuned until the end for an important disclosure statement. As spring approaches and temperatures rise, the U.S. economy is beginning to cool. After a rapid post-pandemic recovery and a period of steady growth driven by resilient consumer spending, the economy finally seems poised to downshift to its pre-pandemic trend near 2% growth. Recent confidence surveys suggest consumers may pull back some and jobs are a bit tougher to get. However, overall consumers remain in good position. A slower growth pace could be beneficial for stocks as it helps alleviate inflationary pressures and supports the potential for additional Federal Reserve rate cuts. We're talking about a slight cooldown, not a collapse. While concerns about re-accelerating inflation remain, they pose a greater risk than a potential recession. Given last year's unsustainable 3% growth rate, a moderate economic deceleration may be a welcome development. With slower growth and easing inflation, the Fed is likely to keep rate cuts on the table, preventing significant spikes in interest rates that could weigh on stock and bond markets. Bond yields have declined this year but remain attractive, setting the stage for a strong year for fixed income investors. While stocks have had a slow start due to tariff concerns, stable yields and cooling inflation provide a solid foundation for the remainder of the year. Another key ingredient for the bull case for stocks is strong earnings. Corporate America delivered in the fourth quarter as S&P 500 companies grew earnings per share by over 18% year over year. Notably, 75% of companies have exceeded consensus earnings estimates, in line with the 10-year average. However, the size of earnings beats was greater than the 10-year average. While projections from strategists for double-digit earnings growth in 2025 may be ambitious, particularly if tariffs persist and trigger further trade retaliation, the overall earnings outlook remains strong enough to support continued stock market gains. This year has been marked by a wave of policy headlines and inflation concerns that have impacted markets and consumer sentiment. The recent market pullbacks were partially offset by gains in the bond market, with the 10-year yield ending the month at 4.2%, more than a third of a percentage point lower than where it started. When interest rates fall, existing bonds become more valuable due to higher yields, helping provide stability in diversified portfolios. Tariffs remain a near-term challenge. Although expectation reductions, delays, or complete reversals may come, some tariffs will still stick. Retaliation by trading partners will likely weigh on U.S. economic growth. Prices on some items will rise as foreign producers and currency adjustments can only absorb so much, making the Fed's job tougher. Industries such as autos, food and beverage, and retail may continue to face pressures. Even with that, don't expect tariffs to derail corporate America's AI-driven earnings gains. Despite economic uncertainty and policy-related risks, we anticipate continued market fluctuations. However, steady corporate profit growth supports a positive outlook for stocks in the year ahead. We invite you to visit our website or on social media to find insightful and timely blog posts addressing a variety of items in this busy first quarter. Please remember, our team is here for you in both stable and volatile conditions. If you have any questions, please don't hesitate to reach out to your advisor here. If you are currently not working with us and aren't having these important conversations with your advisor, we would welcome the opportunity to speak with you.